Hey, good morning. Let's go over today's trade plan. So in the overnight session, for the most part, the S&P held above the 89 high volume node and then made a breakout attempt and actually set a new marginal high on the week. And heading into the open, we're going to use the 94 to 96 quarter as the first and primary area of resistance. Now, overall, the market still continues to be in a very balanced state, and that's why our short-term bias is going to continue to be neutral, and we are going to have to be nimble and flexible with our intraday bias. Now, if the buyers are strong in this market, then ideally ES actually holds above the 89 high volume node and even above 90 quarter. That would still leave the door open for the buyers to step in and make another attempt to break beyond 94 to 96 quarter. On the downside, if we start failing at the 89 high volume node, and especially at 86 quarter to 88 quarter, then it would mark a failed breakout attempt in the overnight session, and we could quite easily then come back and retest 81 to 83 half, and then depending on how we're approaching that zone, we'll have to assess the market and see whether it's likely to hold or is it going to fail at this point. But so far, you can see that the entire week has been stuck in a range. We are right now in a range-bound market. It is a balanced market until we get a sustained break either beyond initial resistance or on the downside below initial support. And as long as we're within initial support and initial resistance and we're not seeing excess strength and persistent upside momentum when the market goes up to initial resistance, or excess weakness and persistent downside momentum at initial support, the market can technically continue to balance within a range. Now, given yesterday's failed breakdown attempt and given the marginal high made in the overnight session, as long as ES is holding 89 and 90 quarter, we are going to give the benefit of the doubt to buyers. And the only time that we would get aggressively short is if we were seeing clear signs of weakness in real time. So, for example, if we were seeing clear downside momentum, or if there were a large bearish disconnect between the advanced decline and the market. So if the market is trading at 90 to 91 near the previous close, but the advanced decline line is quite negative, perhaps minus 800 or something, where there's a big disconnect between the two. In that case, we can aggressively look to find short setups, but if we're not seeing any clear signs of weakness, by default, from a market structure perspective, the buyers are dominant above 89 and 90 quarter. The 86 quarter to 88 quarter is still technically a aggressive area of support. It is in the middle of the current range or balance, so we do need to be cautious at 86 quarter to 88 quarter, because if the market is strong, it probably won't pull back to pre-market support. So again, we will have to assess that situation in real time, but structurally, the market holding above 89 and 90 quarter tells us that the buyers are being aggressive, and they can make another attempt to break beyond 94 to 96 quarter. On the upside, beyond 96 quarter, the overnight high, we have the all-time high at 99 half, and if we are going up on broad market strength and persistent upside momentum, then the door would be open to make a new all-time high, because the 99.5 is not a major area of resistance. It just happens to be the recent swing high and the all-time high, but the 94 to 96 quarter is actually more important resistance than 99 half. So if we can clear 94 to 96 quarter, then we could make perhaps a marginal high, but we can push beyond 99.5. 2303 to 2305 is very much within the average range potential of the day. So on the upside, if we are going up on a lot of momentum and strength in the other markets, then 2303 to 05 is not out of the question. The 09 to 11 area marks a range extreme. So that is an area that most likely will not get tagged. given the lighter volume that we're seeing. But even if we do start breaking out, that's an area that can cap the upside simply because the market would be running out of steam and running out of range by the time it gets there. On the downside, like I said, 81 to 83 half is going to continue to be important, and we are going to have to see a lot of real-time weakness and a lot of downside momentum in order to take that zone out. And given that the market will be coming off of 94 to 96 quarter, if it attempts to break below 81 to 83 half, which again is going to take a lot of weakness, it can still find buyers at 75 to 77 and 70 to 72, simply because again it would be exhausting the range. So those are the main ideas heading into the open. Again, we have to continue to be nimble and flexible with our real-time intraday bias because the market is in a very balanced state. We can't really lean heavily one way or the other. We have to read the market in real time because until we get a break either beyond initial resistance or below initial support, we are technically stuck in a range, we're stuck in a balance, and for that reason, we just have to be a little more careful with our trades within the range, especially in the middle of the range. So those are the main ideas. Let's see how the market responds to 89, 90 quarter, and the 86 quarter, 88 quarter area, and we'll take it from there.